Market structure is actually the most important thing when it comes to forex trading. So let me label some things down for you. As a total forex beginner, these are things you should take as priority. It should be utmost important to you as a beginner in forex trading. These are the guidelines that you should always follow. Number one is risk management. Risk management before anything else. Risk management. Because if you can't manage your risks as a trader, you are heading for failure. Risk management should be your number one priority. You should always, before you even think of calling yourself a trader, you should have a risk appetite. You should tell yourself, even if mentally or written, you should tell yourself that, okay, before this business I'm starting, because take trading like a business too. Take it like a business. Look at it, this business I'm starting, this skill I'm learning, this thing I'm going into. You understand? What should be my risk appetite? You understand? What should be my risk appetite? You'll be able to control your risks and don't go more than that. Let's say you can put it in the sense that since you are just starting out as a business, you start, because forex is a high risk business. It's a high risk business that can make you lose, you can lose all your money if you're not careful. That's why I make it my priority to always emphasize on this risk management. You understand? So since you guys are just starting out and as a total beginner, you're trying to find your way around this whole market, how the market works, and how trading works itself. So you should be looking at your first 3 months, 3 months. You should be looking at risking between 1% to 5%. You should keep your risks here between 1 to 5% on every trade you are taking. On every buy or sell you place, you should keep your risks in between this per day. You start every day you come into the market to trade or to practice, you must keep your risks in between this 1% to 5%. I don't advise people to trade demo, and in this academy I don't advise people to trade demo, because demo is not really it. You understand? There are some things you will learn basically from using a live account that you won't learn from your demo account. So you have to keep your risks between 1 to 5% on every trade you're taking. So every day you must make sure you stick to this rule. Now, if that is in check, next thing you have to learn about is called market structure. Now, so market structure is just teaching you how the market works, how your chart works. You understand? How each of these candlestick works. Each of these red, green candle you see on your screen, how it works. Market structure is teaching how your chart works, how the chart moves. You understand? Or also let you know when market is buying and also when price is selling. And to tell you when price is buying and when price is selling. You need to understand market structure to the very, very least. You need to make sure you understand it, everything about market structure. So you need to pay attention to this class for this week, because this is like your foundation. Market structure is the foundation of forex trading. It's the foundation. Yes, that it's the foundation of forex trading. Like when you want to build a house, you lay a foundation. So understanding market structure is your foundation. You start when it comes to forex trading, which is what we'll be treating throughout this week. So you have to just stay tuned and pay attention. So under market structure, we have 3 types of market structure. We have the bullish, the bearish. We have the bullish, the bearish, and the ranging. Bullish, bearish, some will say ranging or consolidating. Just they mean the same thing. You get it? So market is always doing any of these 3. Market is either bullish, bearish, or ranging. You get? So anytime you open your chart, price is doing any of these 3. Price is either being bullish or being bearish or ranging. Bullish means a buying market. Bearish means a sell market. Ranging means market is just going sideways when you see something is ranging. Or consolidating, just going sideways. It's neither buying nor it's selling. It's going sideways. So that's what we mean by a ranging market. Do you understand? So now that's it. Now, how do you identify these three market structures? How do you identify these three market structures? How do you identify market structure? How do you identify your market structure? How do you identify your market structure? So now, remember what I told you in the beginning. Market structure is like a foundation. It's the main thing you need to understand, because once you understand market structure, you solve like 50% of your trading problems. You solve like 50%, because once you know market structure, definitely you will know when price is buying, you will know when price is selling. And if you know when price is buying, automatically you know you have to buy. If you know when price is selling, automatically you know you have to sell. And if you know, if market is raging, automatically you know you have to stay out of that market. You know how to stay. You know how to stay. You know you have to stay out of that chart. You know you're not to do anything. You just wait patiently to see what price does next. So that's why I say it automatically just solves like 50% of your problem if you can be able to identify a bullish, a bearish, and a ranging market. You start now. I'll start with this. The best place to look at, the best place to analyze, or let me say, or the best time frame, still time frames. Hope you guys understand what time frames are, right? So those of you, anybody has been at the time frames. So the best time frames for market structure to analyze, the best place to analyze, or the best time frames to analyze your market structure at the higher time frames. So also the best time frames to identify, let's identify the higher time frames. Your higher time frames. Good. So now your higher time frames are basically where you identify that the best time frames to identify your market structure. You understand? Because the higher time frames tells you the overall picture, tells you everything that price is doing. You understand? Gives you the big picture, tells you where price is coming from, tells you where price is heading to. While your lower time frames mostly are used to to take your trades, are used to entries. You understand? I used to either day trade or scalp. But the higher time frame gives you the bigger picture, tells you what the market is doing generally. You understand? So the higher time frames are the best place to start to identify your market structure. You work your way down from the higher time frame down to your lower time frame. You start analyzing the market structure down from the higher time frame to the lower time frame. Now, how do you identify your market structure? I've already identified. I've talked about this. I'm giving you the best place to analyze your market structure, the best time frames. Now, how do you identify your market structure? We start with what we call trends. Trends are what you use in identifying your market structure. Trends are what you use in identifying your market structure. We have the uptrend, we have the downtrend, then you have the ranging markets, ranging. So whatever. So now you have the uptrend, you have the downtrend, and the ranging markets. So if you want to identify a bullish or a bearish market structure, you have to use what we call trends. You understand? Trends as what is a repeated action that is happening over time. You understand? It's something that continuously is happening repeatedly over time. When you say something is trending, it means that thing has been happening. You understand? For a period of time, has been happening over time. So trending, the same thing comes into chart. When you hear the word trend, it means that thing has been happening over time, over a period of time, it has been happening for a while. If you say the market is trending in this direction, it means the market has been trending for a while. Understand? So now how do you identify market structure? I see the word trend. Now, what are trends? You understand? We have the uptrend, we have the downtrend, and we also have the ranging markets. Good. Now, trends are made up of what we call highs and lows. Trends are made up of what we call highs and lows. So now, these are other interesting parts. Trends are made up of what we call highs and lows. Generally speaking, when you're talking of market structure, when you're talking of the forex market moves in what we call highs and lows. Trends are made up of what we call highs and lows. Trends are made up of what we call highs and lows. So when price is moving, price tends to create highs and lows when it's moving. And what are your highs? Now, once price moves, it creates a high. The high is that point whereby price stopped buying and started reversing. This is what we call a high. This is a high. Now, while lows, that point whereby price stopped selling and started buying. This is your low. This is called the low. This is a high. Then this is a low. You get it? So low, high. So this is how trends are made up. Trends are made up of highs and lows. Trends are made up of highs and lows. So this is a high, this is a low. Hope you guys understand this. This is a low, this is a high. So now, a high again is that point in which price reverses. Price stops buying and starts selling. That is a high. While a low is that point whereby price stops selling and reversed and started buying. That's a low. Now, how do you use this to make up an uptrend, and how do you use it to make up a downtrend? Next question. Hope you guys are with me. So, an uptrend is made up of series of higher highs and higher lows. We'll start with identifying an uptrend. How do you identify an uptrend? An uptrend is made up of higher highs. An uptrend is made up of higher highs and higher lows. Sorry. So, an uptrend is made up of higher highs and higher lows. So basically, this is what it means. Now, you already know what a high is, and you already know what a low is. So if they say an uptrend is made up of higher highs and higher lows, what they are basically saying is, for you to say price is on an uptrend, for you to say that this market is on an uptrend, of this particular chart or this particular currency pair is on an uptrend, it has to be giving you what we call higher highs and higher lows. And how do price gives you higher high and higher lows? Price has to break your high. So first of all, you will see your regular, you identify your high and you identify your low. Both. Now, at what point does it become an uptrend? At what point does it become an uptrend? As soon as price breaks your high. Do you understand? As soon as price breaks your high, as soon as price breaks this high, it gives you and moves up, it gives you what we call a higher high. anything that makes price to break your high, that is a sign of an uptrend. That is a sign that market is buying, that market is on an uptrend. Go again. You have your high and your low. Price breaks your high. As soon as it breaks your high, it creates and it gives you what we call a higher high. Why is this called a higher high? Because this high is higher than the previous high. You understand? Price broke this high to give you a higher high. Now, where does the higher low comes in? If price retraces again, because remember, market doesn't move on a straight line. Nothing moves on a straight line. You understand? Even life itself is not all beds of roses, and life itself is not all misery. You understand? Nobody can be miserable all the days of their life, and nobody can be all joyful all the days of their life. Life itself has highs and lows. Everybody has their good days, their bad days, their happy days, and sad days. Same thing when it comes to the charts, because this chart now is being controlled by people, you and I. You understand? You and I make up the chart. So definitely our emotions will tend to play out on the chart. Do you understand? Our emotions will tend to play out on the chart. So market doesn't just keep going up. It doesn't move on a straight line. If it creates a higher high, automatically expect it to retest. Automatically expect it to retrace. Now, once it retraces, it will create what we call the higher low. Why? Why is it called a higher low? Because this low is now higher than the previous low. Are we on the same page? Hope everyone is following. Hope we are picking something. Hope we are understanding. If you're confused, let me know. So now, again, price will again, after retracing, price will pick up again, continue moving up again, and break the last high it created. It will break past it, the last higher high it created. It will break past it and give you another higher high. Same thing again, higher low, boom again, higher high, go again, higher low, higher high, higher low, higher high, higher low. So that is why an uptrend is made up of series. An uptrend is made up of series of higher highs and higher lows. That's what you mean by this. An uptrend is made up of series of higher highs and higher lows. So this is what you mean by it. An uptrend is made up of series of what? Higher highs and higher lows. So you have your high here, you have your high there, you have your low here. Then you have your higher high, you have your higher low, you have your higher high, you have your higher low, you have your higher high, you have your higher low. In other words, higher high, then higher low. So this automatically just makes up an uptrend. Are we on the same page? This automatically just makes up an uptrend. So if you see price breaking your highs, just know that that is an uptrend. If you see price breaking your highs, know that that is an uptrend. Do you understand? So now let's go to the charts. It's deeper than this though. We'll get into it. We'll get to every corner, every area of this market structure. We'll get into it. But your first step is in identifying, an uptrend. Your first step is in understanding your highs and your lows, and also identifying an uptrend and a downtrend. Then we'll get much more deeper into this. But for now, before you can even go further, so you can go further, you need to first understand how to identify your highs and your lows, how to identify an uptrend, how to identify a downtrend, which generally everybody should just know, generally speaking, as a trader. You understand? So it gets deeper than that. Now let's go to the chart. Let's give a chart example. What market is bullish right now? Okay. Good. Easiest way. This is the easiest bullish market. Very easy. Now look at this. I'm going to start from. I'm going to just take it back. Start from here. Boom. Now let's play this. Now look at this. So now you have this high. So pay attention. Then you also have this low. But price breaks that high. Automatically, what has it given you? Price has given you a higher high. And you with me? Price has given you a higher high right there. Again, it retests again, giving you what? Higher low. Now again, what are you waiting for? You want to continue seeing price. You want price to continue giving you what? Higher high in this case. You want price to continue giving you what we call higher highs in this case. But you've got another higher high because price has what? Price has broken past this last high it created, giving you another higher high. You got a higher low, but again, you've got another higher high. So again, after every break, after every high price breaks, you'll be expecting a retest. So in this case, you've got your higher low here. Then you've got a new higher high. So basically, this is just an example of an uptrend. You start. I can give you more examples below again. You can see the same thing here again. You have now. This is an example of a ranging market. This is what we call a ranging market. It was just moving sideways, but all of a sudden, price broke past this high. It gave you a higher high, higher low, higher high, higher low, higher high, higher low. So as long as price breaks your high, automatically it's giving you what we call higher highs. As long as it breaks your high, it's giving you what we call higher highs. You understand? Once it breaks your high, it gives you what we call a higher high, then it retraces higher low, higher high, higher low, higher high, higher low. So this is an uptrend. This is an example of an uptrend. More examples again. Let me use this. Let me use this. Good. More examples again. We've got here. You see, the low started here. Got your low, got your higher high, higher low. We've got a higher high. Simple. Let me change it. Let's look at lower time frame. So you see this high here. Well, price broke it, gave you higher high, higher low, higher high. Now here is what we call equal lows. So equal lows again, equal lows here. Then it bounces off again to give you another higher high, higher low, then higher high. Let's just identify as much as you can. Let's say the card, yeah. So another uptrend. So again, low, price broke past this high, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. Let's see if that broke. Let's see if this broke above this high. so that we can call it a higher high. Yes, it did break past it. It did break past it. So we'll call it a higher high. Higher high. Then for one reason or the other, price. See now, another thing you need to note again is this. After identifying your uptrend, another information I need to pass across to you is this. On an uptrend, on an uptrend, price is not meant to break your low. Price is not meant to break your low. Price on an uptrend, price is not meant to break your low. Price is not meant to break your low at all on an uptrend. If price breaks your low, that means it's an unusual something. Price is not meant to break your low. Is that if market is on an uptrend, your low should not be broken for any reason. Do you understand? So now, if price breaks your low, it has to do with two things, which you will be learning during your master class. You understand? Which you'll be learning probably on your second month. You get? But now, price is not meant to break your low. There are only like two reasons why price wants to break your low, why price should break your low. You understand? Two reasons. And number one reason is this, is what we call liquidity. If not, I'm sure you must have heard of it somewhere, but I'm not going to get into it today. This is just a total beginner's class. That information is for your master class. So it's called either price wants to take out liquidity, or number two reason is change of character. Price wants to change trend. Price wants to change trend from an uptrend to a downtrend. You understand? Which we'll be looking at either today or later tomorrow after identifying the downtrend. You understand? So those are just the two reasons why price should break your low. The first one you'll learn during master class. The second reason I'll be showing you tomorrow or later today. Now, another thing also to note, another side note again, another thing to note on the side is this. For you to confirm an uptrend, you must see at least two higher highs. For you to say that this is an uptrend, for you to establish that this is an uptrend on the chart, you must see at least two higher highs. At least two higher highs. Before you can establish that this is an uptrend, you must see at least two higher highs. If you can't be able to spot two higher highs, then you don't have then that uptrend is not confirmed. That uptrend is not confirmed. You understand? For you to confirm that uptrend, you must spot at least two higher highs. You must spot at least two higher highs. So in all cases, you could see the same thing here. You could see first higher high, then higher low, then boom, another higher high. So at this point already, you will be looking for buys. As soon as you give it this second higher high, you're already looking for buys to continue with the trend. So that's what confirms an uptrend. At least two higher highs before you can say that is an uptrend. Do you get it? At least two higher highs before you can say that is an uptrend. As soon as price broke past this high, this was your first higher high. It retraced again, higher low, moved again. This is another higher high. You see? This is another higher high. And one thing you will notice is this. Your higher highs usually are in form of, if I have to draw a triangle on these highs, it will sit. Do you see? Can you see? It's in the form of
Yes, sir.
this triangle shape. If I put it here too again, you will see it. You can see it, right? So that is what you are looking out for to identify your highs. You get it? Not just single candles. It must give you the form of what? This triangle shape. Invalid high. You can see this triangle shape. That's how you get your higher highs. That's how you get your highs. You can see triangle shape. Again, here you see the triangle shape. But here, this is very, very important though. Trend. If you can't identify this on your own, you are cooked though. If you guys, none of you are able to identify your trend. And once a market is trending upwards, it is a sign that that market is bullish. It's a sign that that market is bullish, that you should be looking for buys. Do you understand? Once the market is trending upwards, because the general purpose of you identifying an uptrend is for you to identify a bullish market. If you see that the market is on an uptrend, that means automatically that market is likely to be bullish. You understand? That market is likely to be bullish. So, and if the market is bullish, you are meant to be looking for buys. Do you understand? You are meant to be looking for buys. We're looking at what we call a downtrend. How do you identify a down? How do you identify a downtrend? So for an uptrend, we've already established that price must be giving you higher highs. Price must break your highs for you to say that that's an uptrend. And I said you must see at least 2 highs. You must see at least 2 highs. You understand? 2 highs to confirm that uptrend. You must see at least 2 highs to confirm the uptrend. While for a downtrend, it's actually just opposite of what an uptrend is. For a downtrend, you understand, a downtrend is quite similar to the same thing as it's similar to what we call a bearish market. If we say market is on a downtrend, automatically you're trying to say that market is bearish. Now, how they are just like slight difference, you understand, from you saying that market is bearish. Because for you to say a market is bearish, that means it has to be on a downtrend on the higher time frame. You understand? Because a bearish market structure, it means that price is selling. And for you to confirm a bearish market structure, you have to be looking at the trend from the higher time frame. Because market structure is, like I said before again, you understand, market structure is the overall directional bias of the market. And market structure can also be defined as the overall outlook of the market, either in a bullish or bearish trend. So that's why I say you have to look at it from the higher time frame, because the higher time frame, if you look at your trend from the higher time frame, it gives you the overall outlook of the market. You understand? So that's where you'll be able to like specifically say, okay, this market is bearish, this market is bullish, because your lower time frame just tells you what is happening now. Do you understand? Your lower time frame tells you what is happening now. What is the trend for today? You understand? So that's why as day traders or as scalpers, you mostly use the lower time frame. You get it? But overall, if you want to see the bigger picture, if you want to see the overall outlook of the market, you go with the higher time frames. The 4 hours, the daily, the 2 hours will tell you, okay, what the market is doing generally. Do you understand? They'll tell you what the market is doing on the long run. Do you understand? So if you're able to identify an uptrend on the higher time frame, that means the market is likely to be bullish, to be a bullish structure. If you can identify a downtrend on the higher time frame, it means that that market is likely to be bearish, a bearish structure. Because a market can be on an uptrend on the lower time frame and be a downtrend on the higher time frame. That happens. You can have an uptrend on the 30 minutes, on the 15 minutes. Then when you go to the 2 hours or the 4 hours, you will see what? You will see a downtrend. I can give you an example. CAD JPY or even Euro JPY. I'll give you an example on this. Or CAD JPY. Now, you look at this trend. This is, if you're just looking at this, it's generally just an uptrend. Just by looking at it, you should be able to spot it. Higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low, higher high, higher low. But if I take it to the 30 minutes, you will likely see something different. What I say, a bearish market. You see, market. This is a not a downtrend. Low, lower high, lower low, lower high, lower low, lower high. I think I've not explained fully what a downtrend is. Now, a downtrend is made up of series of lower lows. Let's quickly talk about this before we continue with our space. A downtrend is made up of series of lower lows and lower high. So basically, what do you mean by this? For you to say market is on a downtrend, price has to be breaking your lows. For you to say that market is on a downtrend, price has to be breaking your lows. Price has to be giving you what we call lower lows. Now, an uptrend, price is breaking your highs. That's how you know that is an uptrend. But for a downtrend, price has to be breaking your lows, has to be giving you what we call lower lows and lower highs. So you have to see price break your low to give you a lower low. Well, if you break this low, you have a lower low here. Then it will retrace again, give you what we call a lower high. Then break this previous low, give you a lower low. Retrace again, lower high, lower low, lower high, lower low, lower high. So this is an example of a downtrend. I can give you an example here too. This is it. You have your high, broke this low, lower low, lower high, broke this low, lower low. Now again, equal, it gave you another set of highs here, equal highs, then bow, a lower low. This is an example of a downtrend. So I'm sure you guys must be hearing me say equal highs or equal lows. Basically, what I mean by that is this: both highs, they are not higher than the other. They are both sitting on the same area. Yes, that if you hear me say equal highs, it means they are both sitting on the same zone. You understand? They are not. One is not higher than the other. Like if you see now, see this high is higher than this high. So this is a higher high right here. You understand? Why this high is not higher than this high. So you kind of have what? Equal highs. You understand? So that's what we mean by equal highs. While equal lows is just basically two lows sitting on the same level, sitting on the same zone. Let me see if I can give you an example of equal lows. Okay, yeah, good. Equal lows. These equal lows. You get it? Equal lows. They are both sitting on the same level. So that's what we mean by equal lows. One is not lower than the other. They are both sitting on the same level. But if this was lower than this, then you say that's a lower low. So back to a downtrend. A downtrend is made up of lower lows and lower highs. Lower lows and lower highs. So let me take it to the 4 hours again. High, low, lower high, lower low. Equal highs, then another lower low. So a downtrend is made up of lower lows, lower highs, lower lows, lower highs. That's what a downtrend is made up of. Now, also to confirm that downtrend, remember what I said, you must see at least two lower lows. You must see at least two lower lows. You have your first low, your second low. So this has confirmed that this is a downtrend. Same way for an uptrend, you must see at least two equal highs to confirm. You must see at least two higher highs to confirm an uptrend. You must see at least two higher highs to confirm an uptrend. Question here. A lot of you have masters in Forex already.
No, really, sir. I think I have a question, sir.
Shoot.
Is there any possibility for, you said we should wait for confirmation? That's if it's an uptrend, should wait for at least 2 higher highs.
Yes.
Is there any possibility for it to automatically turn bearish after
Yes, now.
forming
Yeah.
the
Yes,
two
now.
higher?
Yes, now. You can see. Which example do I want to give you now? Let me show you. Okay, here now. I'll give you this. Now look at this high, this low. Then what do you have here? A higher high. Am I right?
Yes.
Right? Okay, good. So you have a higher high there. Now, what happened next? Remember, on an uptrend, price is not meant to break your low. Do you remember?
Yes.
Price is not meant to break your low. If I give you different examples, you will see. But what happened here? You can see it broke the low. Do you see it? So now, in the case like this, that it broke this low. You understand? In case like this, that it broke this low, does this mean that this is a downtrend?
Not really.
Not really. Based on what I told you, a downtrend, for you to confirm a downtrend, you have to see what? You have to see 2 lower lows. Exactly. Did he give you that? No. So you know that this is not a downtrend yet. You understand? So you still keep your eyes looking out for what? A buy. Do you get it?
So that's more like a reversal trend, or what did you call that one?
This now, I don't want to talk about it today. You're supposed to know about it during your masterclass. We'll treat on that during your masterclass, not today. Do you understand? But just take it for example. That's why I made that statement. For you to confirm a downtrend, you need to see 2 lower lows. For you to confirm an uptrend, you need to see 2 higher highs. That's what. Use that guideline, and you will be able to avoid things like this. You'll be able to avoid traps like this if you use that guideline. Make sense?
Yes, sir. Thanks a lot.
Good. And now, lastly, let me explain these 2 points. For this, I have to change the candlestick to lines. Or let's go back, so I won't confuse with you guys. Now, during an uptrend, you see that low that give the higher high. That low that gave you your higher high, that made price break your higher high, is that low that is your higher low. That low is what you call your higher low. That low that gave you the higher high is that low you call your higher low. That's why you see in this case, if you look here, I did not mark here as a higher low. I use here in this case as a higher low for this higher high. Why? Because this particular low you are looking at, you get it, did not create a higher high. Pay attention closely. If you look at it, it did not break past this high. Instead, what did it give? Equal highs. Equal highs is different from higher highs. Do you get it? Equal highs is not higher high. So this low failed to give you a higher high. So this low was not your higher low. Where's your higher low? This low that gave you the higher high. Lastly, pay attention. This is going to help you in the future when I start saying some things. Your higher low is the low that gave you a higher high. If that higher low did not give you a higher high, it's not a valid higher low. So price can easily break it. Most times, price can easily take it out, then give you its own higher low and higher high. So don't count these lows that didn't give you a higher high as your higher low. Am I making sense? Then for a downtrend, Same thing for a downtrend.
Please, can you repeat? I'm a little bit confused.
Yeah, are you speaking to me?
Yes, please, can you repeat this
Okay,
stage?
it's
I'm a
okay.
little bit confused.
Okay, good. So I said now, an uptrend is made up of higher highs and higher lows, right?
So,
Good. So now, that higher low that we are talking about, for it to be a valid higher low, it must print a higher high. It must give you the higher high. It must be the low that gives you the higher high. If that low did not give you a higher high, it's not a valid higher low. Like this case here now, this is a perfect evidence. This one said, this guy. This guy here. It did not give a higher high. It did not break past this previous high. Now, when we mean break, and you guys would have noticed that I'm not usually talking about when the candlestick break with a wick. No. So this is what we call, let me just quickly speak about this because you guys are beginners. This is what we call a wick. This thin part is a wick. If this part is what broke above your high, that is not a break. A break is this is a break when it breaks with the body of the candle. When it breaks with the body of the candle, that is a break. Are we here? When it breaks with the body of the candle. Now that's by the side. Now, back to explain it. This guy did not give a higher high, failed to break above this high. You understand? It failed to break above this high. So this is not a higher low. It did not give a higher high. Where is the higher low? This one. Because, look at it. This low is what printed this higher high. This low is from here price bought and created a higher high. Do you understand? So that is a higher low. Same thing as here. This is a higher low. This low gave you this higher high. Same thing as here. This low gave you this higher high. Same thing as this one. It gave you this higher high. Same thing as this one. It gave you this higher high. Same thing as this one. It gave you this higher high. You get it right? Are we clear?
yes,
Do you understand now?
yes.
Good. So now, same thing for a downtrend. That downtrend now, for you to say it has that high is a valid lower high. Let's give you an example of a downtrend. For you to say that high is a valid lower high, it has to give you a lower low. If it doesn't give you a lower low, it is not a higher low. It's not a lower high, sorry. If it doesn't give you a lower low, it is not a lower high. You get it? It is not a lower high. This is a daily time frame. Okay. I'm trying to look for an example for you. Anyway, you have this lower low, lower high, lower low, lower high, lower low, lower high, lower low here. Then now you have a new lower high. Yeah, we do lower high. So what are you expecting? A lower low. I'm trying to see if I can get an example of what I'm talking about. See now, this is another scenario. Look here. Look at what's happening here. You have this low, print this higher high. In fact, let's see what I think this is the first place. This low, give you this higher high, then boom. You now have this then you have this lower high again, then you have this lower low. Now don't get it confused. This high did not break this low. Did you see it? If I delete this now, you see it. It did not break this low. So in this case, you don't have two lower lows yet. You just have this lower high and the lower low. Do you get it? There's no two lower lows yet. So this has not confirmed that this market is on a downtrend. Do you get it? It can still buy. So it's very, very important you pay attention to this, to your lows and your highs. This is where a lot of people make mistakes. You understand? Pay attention to, when you're on the chart, pay attention to every low and a high. Is it breaking? Is your highs breaking your lows, or is your low breaking your highs? Is your low giving you higher highs, or is your high giving you lower lows? Pay attention. If it's not giving you that, then figure out what's happening on the chart. Test that. Make sure for you to establish a proper trend, you must see that lower low or that higher high. If price is not giving you a lower low, that is not a downtrend. If price is not giving you a higher high, that is not an uptrend. So you must see at least two higher highs to confirm an uptrend, and two lower lows to confirm a downtrend. You get it? So in this case now, we've not yet confirmed the downtrend. We've not yet confirmed the downtrend at all. And as you can see, market is already rejecting from this low. We've only got one lower low, which is this. The market is already rejecting from here. It could possibly still, you could still see something like this and start forming higher highs to start giving something like this. If you start seeing something like this, know that the uptrend is going to continue. So in situations like this, you want to be patient. You don't just take rash decision. Market is selling, let me sell. No. You want to confirm the move. You understand? When it comes to trading, you have to be really patient. You have to confirm that structure. You have to confirm that move before you strike. It's like when you're in a battlefield, right? You don't just, if you're in the military, you don't just shoot anybody anyhow. You have to confirm that that is the enemy before you shoot a bullet, unless you'll be charged with manslaughter. You understand? You'll be charged with what we call involuntary manslaughter. You get it? So you must confirm that that is an enemy before you what? Before you strike. So same thing on the chart. You must confirm that that is a downtrend before you sell. You must confirm that that is an uptrend before you buy. If you can't get that confirmation, like in scenarios like this now, you don't have to do anything. Do you understand? You don't have to do anything because you only have one low, not two lower lows. You understand? And also, price has broken your low. So this is not giving you an uptrend again. You understand? This uptrend is not yet valid for you for now. Do you understand? The previous trend was an uptrend. Do you see? You had this higher high, higher low, higher high, higher low, higher high, equal lows, then higher high. Now, what do we have here? Just one low. So, this now, it has broken this low, which is not supposed to break. Do you understand? Price is not supposed to break that low, but it has broken that low.
Hmm?
Do you get it? So, in cases like this, if you exercise patience, you want to confirm that trade, you want to confirm that move. Remember, you don't have to trade every day. Trading is about patience, risk management, and market structure. That is trading. We'll continue more on this tomorrow.